Richard Lindquist, high-yield bonds took a big hit at the end of 2014 when oil prices plummeted. They've come back since, so has oil. So before we talk about where high yield is now, tell me, was that sell-off justified back then?
Well, I think at the end of 2014, people didn't know exactly where the bottom was in oil prices. So to some extent, a big part of sell-off probably was justified. And it forced people to do more research on their energy holdings to find out which companies had good hedges, what type of access to issuing debt or equity they had. And once oil prices started to bottom, I think people felt a little bit better about the energy sector.
And how do you feel about the energy sector now and its relationship to the high yield sector?
Well, I think the way we look at energy, it's really in four different buckets. You have midstream companies, which generally have been fine and will continue to be fine because they're volume driven. You have the E&P companies, and there you really have to distinguish credit by credit based on leverage, hedges, ability to raise cash. A lot of them cut capital expenditures to save cash. Then you have coal and natural gas, which remains a difficult part of the market. And then you have the service companies in the energy space, which are going to be the most severely tested in 2015 due to all the capital expenditure cutbacks by the E&P credits.
And what about outside the oil patch? One would think that with low rates and a slow-growing economy, it would be a good time for high yield right now.
Yeah, generally speaking, high yield performs best in a 0 to 2% GDP growth bucket. Performs slightly worse with a 2 to 4% bucket, and even worse with a 4 to 6% bucket. And obviously, the worst case is negative GDP growth or recession. So I think generally high yield is in a pretty good place right now. And consumers do, because of the lower energy prices, do have some extra discretionary money to spend on other things if they so choose.
And which sectors do you like?
We still like a lot of the cyclical industrial types of sectors that still are slowly recovering since 2008, 2009. We also like some of the more consumer durable related sectors as well.
And what about issuance? Because that's always a big thing when it comes to the high yield market.
Yes, well, most of the issuance, fortunately, has been used over the last several years for refinancing. So it's been a big new issue calendar, but on a net basis, it hasn't grown dramatically. And just as importantly, we haven't seen a big pickup in leverage buyout activity, which oftentimes in the past has signaled higher default rates sometime in the future. So that part of the new issue market has been relatively low.
But are investors getting rewarded for the risks they're taking? People are talking about a toppy stock market, and the high yield market is pretty close in the capital structure to equity.
Yeah, I mean, high yield sits right above equity, and obviously we have senior debt in front of us in many cases. But I think given the outlook for relatively good economy, relatively low default rates, they've been running in the plus or minus 2% area, and the fact that spreads did widen in the fourth quarter and haven't recovered back to where they started entering the fourth quarter, I think the entry point right now is pretty good for high yield.
And what will happen if and when the Fed raises rates?
Well, that's obviously the biggest wild card in these markets, and the expectation has been for quite some time at some point the Fed's going to start to raise rates. The real key question is when and how quickly. And so I think they're going to well telegraph the first rate rise, try to minimize any damage, so to speak, to the markets. But I think it's still an unknown, how investors are going to react to that. If the rate rise is slow and gradual and absorbed fairly well by the markets, I think you won't see that much of an impact to high yield. If it's kind of a panic mode where people are worried that the Fed's going to move rather quickly, then you may see a more dramatic sell-off. So it's really hard to predict until we get closer to that point.
And do you have a view as to when that point's going to be?
Well, I think generally, our chief economist at Morgan Stanley Investment Management thinks no earlier than September, probably more likely later in the year. My view, maybe even a little slower than that, maybe even into 2016.
All right, thanks a lot, Rich.
Thank you. Appreciate it, Greg.
And thank you for watching The Street.